Okay, I'm going to start several minutes early, as in now, because I've got a ton of charts in this one. I think the best way to learn really is, visually, at least for me, instead of a bunch of words on a slide that you don't want to read anyway, maybe. So hopefully you get something out of this. This is a little different, bigger picture kind of stuff, maybe from this morning. We're going to be looking at a lot of commitment of traders reports, a little bit of SSI. The idea is to try and quantify sentiment as much as we can in this presentation, and have an idea of when to be a contrarian, right? Because it doesn't pay to fade the trend for very long. Speaking from experience, you want to be with the trend, but there's the worst time to be with the crowd or with the wrong side of the trend is when it suddenly violently turns. And in markets like FX, which is highly leveraged, the turn is usually pretty sharp, more so than equities, which can take a while to top out, for example. All right. FX can change. Just look at the 160. We were at 160, then we were at 150 within several weeks, okay? Or even the December top, 150, we were down at 145 within a matter of days. Okay, so probably not your first presentation. This is the risk disclaimer, though. Bottom line is you can lose, you can also win. Most people lose, and understand that before you jump headfirst into this endeavor. Okay, so just a couple quotes from some very famous, very smart men in the world of finance, the history of finance. Bernard Baruch, famous speculator from the 20s and 30s, right? All economic movements, by their very nature, are motivated by crowd psychology. And let's think in terms of markets, right? Markets are not economics. All right? The model of economics is wrong when it comes to speculative activities, right? People think of supply and demand driving markets. That is the case, but for agricultural goods and whatnot. But let's think of currencies or equities. If you were to think everybody starts to buy, okay, right? So you have supply, demand, right? Everyone wants to buy. Demand's going up. Well, there's just as many sellers as buyers, right? The demand's not changing. For every buyer, there is a seller on the other side. Arthur Pigou, an era of optimism tends to create a certain measure of psychological interdependence until it leads to a crisis. Then the era of optimism dies and gives birth to an era of pessimism. We can just think of this as the oscillation of these two emotions, optimism and pessimism, going back and forth, right? Optimism creates the uptrend. Too much optimism gives way to exhaustion, and there's no buyers left. And then you begin the decline. And then the same process repeats, but the opposite. And this is the ongoing battle between these two emotions, these two groups, which creates the market trends that we see on the charts. Okay? The popular efficient market hypothesis, right? The markets are efficient, espoused by the academics back in University of Chicago many years ago, and was really the central theorem that governed finance for a long time that everyone subscribed to, but it's wrong. It doesn't work. Okay, and this socioeconomic theory of finance or behavioral finance is more what I subscribe to, and you can see the differences here, right? The EMH says that there's objective, conscious, rational decisions. That could be further from the truth, right? Have anyone ever seen a trading floor? It's not a conscious or rational. It looks insane, right? Subjective, unconscious, irrational impulses is more the rule in financial markets, in trading and investing. Financial markets tend towards equilibrium. Yeah, they might be at equilibrium at some point, but they spend a lot more time further from equilibrium than they do at equilibrium, right? Financial markets are dynamic, If the financial markets tend towards equilibrium, why have we gone from 666 to 1100 in the S&P over the last year? And so I don't know about equilibrium. Decisions based on knowledge and certainty, that couldn't be further from the truth. A lot of people base their trading decisions on things they have no idea about. You can't possibly know everything that's going on in the market at all times. There's much more uncertainty than certainty. Outside variables determine most decisions, right? The markets are a cause and effect relationship. That's not the case. It's not like physics, right? A lot of these things are internal to the market itself. The psychology of the market is driving the market prices, which is determined inside. Financial prices are unpredictable. Financial prices are probabilistically predictable, right? You can have an idea, assign a certain probability that the uptrend's tired and it may reverse. You can't say it's going to reverse tomorrow at this price and then fall to this level, but you can have an idea as to whether it's overbought and to what degree it's overbought, and then look in the past and say it's been overbought before like this, and this has happened, right? So 5 times out of 10, 9 times out of 10, 7 times out of 10, whatever, the price has declined when this and this has happened. Okay. Economic data and FX trends, no correlation. What I mean by this is I'm not talking about very short term like intraday, release comes out and then market starts gyrating back and forth. I'm not talking about that. What I'm talking about is the long-term impacts that these data apparently have, according to many analysts and traders. All right. Here's the NFP changes. These charts are a little old from 06. Okay, I just haven't updated them, but you get the idea. So over a very long period of time. Okay, here are the dollar index with NFP changes, monthly NFP changes. And on the bottom we have the correlation. Okay, it's interesting here that the correlation goes back and forth from positive to negative. And let's look here. You can see when conventional wisdom would say when jobs are being created, that's when the dollar should be rallying, right? Well, interestingly, you have a lot of points where jobs are at their highest when the dollar's at its lowest. Here, okay? Jobs dip here, dollar starts rallying. I mean, there's just really no correlation. You can't get any trades from this. The dollar actually was exceptionally strong in the early 2000s when jobs were at their lowest point, all right? And so when NFPs, and this is jobs created, when NFP bottomed out and more jobs started being created, the dollar actually started declining. So, rationalize that. All right, going a step further, looking for the surprises, so-called surprises. These are some of the bigger surprises that have happened over the last 10 or so years. All right, I have the actual minus the expected non-farm payrolls numbers. So, and the deviation. So what this minus 206 means is that NFP missed expectations by 206,000, okay? Now, in that instance, the dollar index fell 3% that month, right? Which would agree, okay? Let's say that would agree with the assumption that outside forces like NFP set the stage for the month for the dollar, okay? Which is, some people will argue. November 99, missed expectations by 227,000. The dollar actually rallied almost 3% that month. So that would be opposite. August 2000, same thing. June 2001, there was really no change, right? The dollar really didn't go anywhere. April 2003, that would be agree, as you had a missed expectations of 312,000. The dollar fell almost 2%. May 04, disagree. September 04, agree. So you can see sometimes it works, sometimes it doesn't. GDP and the dollar index actually move opposite one another until 05. So when that GDP report comes out and you hear that the U.S. economy is growing by 3% or whatever instead of being negative, and you get bullish the dollar for that reason, it's not the right reason to be bullish. You may want to be bullish the dollar, but be bullish for the right reasons because GDP has nothing to do with it. The trade deficit's been increasing forever. The dollar's gone both ways, right? There's no correlation. This is tick data, right? International Treasury, capital flows. It's very volatile, but on balance, it's gone up over the years, and the dollar's gone both ways, obviously. CPI, some would think that the dollar would increase if CPI were positive because inflation expectations and interest rates would then be increasing. Therefore, the dollar would probably be rallying as it gets more yield. Such is not the case. In fact, most of the time, the correlation is negative. The dollar rallies more or less in deflationary environments. This is the Fed funds rate. This is the biggest one that everyone loves to watch, right? Well, you can see the Fed funds rate decreasing for much of the 80s. The dollar had its strongest rally in history that decade. You can see the Fed funds rate being flat for much of the 90s and the dollar rallying. Okay, there are periods when the Fed funds rate has gone, increased for a while and the dollar's declined. Okay, this is one of the bigger, more fun macro things to look at is magazine covers. And not necessarily, the Wall Street Journal or, big newspapers such as that, although we'll look at that in a little bit. But when you have something like The Time or even The Economist, which deals with, a lot of social issues, when you have them featuring specific markets on their covers, that means that you're at a sentiment extreme. They're in the business of selling news, right? So if their editors think that the price of the euro-dollar exchange rate is worthy of a major magazine cover, then it must be, and everybody must know about it, right? So these are the three big ones to look at. Here's just some more of the famous examples in the history of, the magazine cover indicator. And again, this is not an indictment on the magazines, right? It's not like they're not supposed to be good investors or traders. They're supposed to sell magazines, right? So they're doing what they're supposed to be doing. You can see, this is famous, probably the most famous one. In 1979, they advocated, basically buying things such as diamonds even over equities. That was the best buying period in the history of mankind, right? This is a good one from Time, featuring the $1 bill image of George Washington with a black eye. This is when the dollar was in crisis mode back in the late 70s, right? That's naturally, a cover such as that's only going to appear when everybody is bearish the dollar, and the dollar's a big news story, right? No one's going to buy it, the magazine cover, unless it's interesting. This, couldn't find an image for it, but this was after the 79 low. You can see we rallied up to the mid-80s, that massive rally, right? And there was a cover that came out that said, "Super dollar overdoes it." That pinpoint at the top, I think it was to the week, to be honest with you. This is a little closer to where we are in history now, but the Euro Shambles Economist cover came out in late 2000. The euro had been in existence for about 2 years at that point, and economists and experts everywhere were just deriding the idea and saying it was a disaster. They never should have done it, blah, blah, blah. They probably shouldn't have, obviously, if we're looking at it now. But look what happened over the next 10 years. We went from 85 to 160. Here's an 04 one. You might remember this one. Let the dollar drop, The Economist. Okay, that pinpointed a low in March of 04. Similar one in 05, the disappearing dollar, right? 2005 was the largest U.S. dollar rally in years, almost 20% against the euro. I think the euro went from like 136, remember, to 116 or so. Here's one of, not necessarily on the yen, but it is applicable. The Economist had the sadness of Japan And remember, this is a dollar-yen exchange rate. So as the dollar-yen goes up, that means the yen itself is falling. The sadness of Japan pinpointed a yen bottom, a dollar-yen top at 135 that week. And, over the ensuing months, you can see the sharp initial decline. But then even over the ensuing years, the dollar-yen fell to 100. And here's a couple more recent years at intermediate term tops, right? The falling dollar, the panic about the dollar. I have a German magazine there too that I found online, but whatever. We don't know the degree to which these tops are going to be. Usually they are pretty significant tops. These were less significant tops. That may speak to the amount of credit that was, in the system at the time. Okay, and why these trends kept moving higher. And obviously it's not just, this is a social phenomenon. It's not just to currencies or equities. It's any markets, and it really can be anything, right? It happens all the time with even celebrities. So celebrities pictured on the cover of some major magazine. Oftentimes it's their peak influence or fame. Okay. You could just look at Tiger Woods. Oil, and this is an oil one. You can see this is in June of 08, and oil, graced the cover of Business Week. It shot up from about 125 after that article, closer to 145, remember. But then we know what happened. It tanked to $35. Okay. Going a little shorter term, for shorter term trades, day or two trades, you look at the Wall Street Journal, the New York Times, business section, and finance, Google Finance, and you're looking for extreme words, right? Words like surge, explode for tops. And again, this should be short-term tops. And this is just a function of after a market's made a major move, natural thing, it's going to consolidate it, right, anyway, okay? And sometimes a consolidation may lead to, if it's a volatile market, you may have a couple hundred pips on the downside. Who knows? But bottoms, plummet, plunge, tank. The point is that the headlines, the writer of the article felt compelled to use strong language, right? Because the move was that emotional. It means it's probably due for some sort of retracement. Okay, and then the best reversals are the ones that occur when the headline contains an outlook within it. And I'll add something to that. Also, headlines, the best headlines to go contrary to are the ones that are made by government officials. You'll see what I'm talking about in a second. It's actually amazing. So some of these down here, just examples, right, of when these occurred. This is the euro. So as, increasing price means the dollar is declining. You'll see the bearish ones at the bearish dollar headlines at tops in price here. Okay, so you can just look over some of these. Some of them can be kind of funny, to be honest with you. Let's see. Dollar is expected to remain strong on optimism over war. War is like the worst thing that humans can do. You're killing each other. But you can read that headlines and whatever. Think about how you want. I don't know. Here's some more. These are yen, dollar yen. Again, as the price increases, that means you see yen bearish headlines or dollar bullish one, right? Yen's plunge takes toll around the world. That was the high 99, dollar yen high 99, I should say, yen low. This is the best one. Hold on. Look at this. I'm not joking. 11/28/2005. Go look at a chart. On November 28th, 2005, that was the low of the pound at 170. It's like 170.05, if I remember correctly. And that day, there was a headline on Bloomberg that said Bank of England says dollar looks like a good buy. It's their own currency. So after the pound dollar declined from 195 to 170 in a matter of months, the Bank of England came out advocating to sell the pound dollar. Well, then, it rallied up to 210. Okay, so getting to more maybe technical methods, commitment of traders data. Probably a lot of you are familiar a little bit with COT stuff, right? There's two groups, commercials and non-commercials. In the origin of the futures market, explains why you need, in FX and in commodities, there's a long for every short. Not the case in equities. In equities, you can have wealth creation, destruction. There's a winner and a loser. It's a zero-sum game is the actual truth in futures and in FX. Right? Originally, you had farmers and stuff that needed to bring their crops to market. And they wanted to lock in a price, but maybe they couldn't find everyone to buy it, so you had to have someone fill the void. Well, that's where speculators come in for liquidity purposes. And speculators are going to take the risk of an adverse price reaction from a hedger who just wants to lock in a price. Okay? And the way to look at these two groups, they are directly opposite one another. As commercials sell, speculators will buy, and vice versa. Commercials will be longest at the bottom. In other words, they're going to trade against the trend the whole time. But they will have the most in their inventory as price is the lowest. Shortest at the top. Okay, so they'll be short or have the least amount at the top. And you can see this, for example. This is, again, futures data, right? But you can see pound dollar, pound futures. These are commercials, and they have the least amount of British pound currency at major tops. And they have the most at major bottoms, right? There's that bottom. That's that 11/28, 2005 Bank of England buy the dollar recommendation. Combine that with the COT thing, and you have a trading signal. Here's an example in the yen. In this case, the dollar-yen spot price, you have to reverse the chart, right? Think of the inverse, because as commercials are long yen, that means the yen is actually bottoming out. But on a chart, it's topping out because it's the counter currency to the US dollar exchange rate. This is the Australian dollar, just several examples. Okay, and now the other group, the speculators or the non-commercials, they are trend following. Okay, most bullish at the top, most bearish at the bottom. So there are speculators that do get in at the right time, early or in the middle of a trend, and they ride that trend. But the majority of the trend followers will end up buying at the worst time or selling at the worst time. They'll buy after price has risen substantially, and they'll end up buying at a top, or they'll end up selling at a bottom. And that's reflected here. You can see the troughs indicate bottoms in price. So speculators move with price. They follow the trend. Okay, and then a majority will be long, or a great deal will be long at price tops. You can see that here in the pound dollar. This is the dollar CAD. Again, you have to dollar CAD with the dollar as the base currency. You have to invert the chart. But again, these speculators will be very long. The Canadian dollar at dollar CAD bottoms or CAD tops. It's the same thing. Okay, so since they move directly opposite one another, might as well just make one signal with both sets of data. And again, to review, speculators are long when commercials are short and bottom. Top in price occurs when specs are long and when commercials are short. Speculative positioning, as I mentioned, is going to be correct for the meat of the move, right? But it's wrong at the turn. So you want to be with the commercials at the turn, but you want to be doing what the speculators are doing when there's a trend, which is the trend following. So again, move directly opposite one another. This is euro. So in order to make a signal that moves with price, we start with the speculative positioning and subtract the commercial positioning. It just gives us one figure, and that looks like this. And you can see it crosses the zero line when that's basically the cross of the two groups, but crosses the zero line, and that's going to be correct for the whole time of the move. But the big intermediate term tops and major tops are going to occur when that indicator tops out as well. It's just dollar yen. Okay, so even to make it better, to make it a more objective indicator, we index it. In other words, you want all the values to fall between 0 and 100, so you apply a percentile in order to measure where it is in a X amount of periods. I look at 52 and 13. 13's better. 13 is just 13 weeks, right? 1 quarter. And then we have something like this. So this tells you when it's high, when it's low, when it's at 100 or 0. You can see there. That's the dollar index itself. And as I mentioned, a different look back is going to provide a different perspective. 13-week look back, shorter term, 52-week, longer term. Now you have to understand context. If there's the most amount of speculators long in 13 weeks, that might indicate the beginning or middle of a trend, right? Once it changes, okay, or once you get a bearish extreme after a rally, that in itself is bearish because that means the price, the sentiment has turned, and you'll see what I mean. When I publish this report every week, the COT report, with what I'm going to show you, these kind of charts, this is the paint function on TradeStation, and what it is when it's at 100, it's blue, and when it's at 0, it's red. Now, there's ways to look at this. After a substantial decline in price, if you have a reading of 100, that's actually very bullish on a 13-week basis, right? As prices turned, speculators have caught on and gone long, okay, and that new trend's beginning. If you have a substantial rally in price, and then speculators, you have a slight turn in price, and speculators all of a sudden go short, that's bearish. You can see how that happens. You have a lot of, looky here at, if I can get this thing working, there we go, right? Turns of 100, 100, okay, 100 here, here, whatnot. Now you also are going to have, after a substantial move, if you have a movement from 100, such as here, 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 and here, right, all these times. So what you're trying to do is use this, if you saw this morning's presentation, right, points of reference, everything's about points of reference. So say you get 100 or a 0 reading. So has price been increasing for a while, or has it been decreasing for a while? If it's been rallying for a while, and we get a 0 reading, and then price starts to weaken, we go with that. Okay, if we've been rallying for a while and we have a 100 reading, it might be a sentiment extreme top. Say we start to decrease off that, and then we go with that. This is the Euro futures contract plotted. This is pretty recent. I just put these charts. This chart's probably from like Friday or Thursday. So you can see we've been bearish, indicating bearish extremes for a while, right? And we've gone for, the declines continued. Now, you might want to start to watch out because you can see here we're at an all-time record for speculative shorts and commercial longs. We have never had this big of a record, but extremes can last a very long time, right? Just look at how long speculators were long the euro the entire time it went up. Just the case now on the opposite side. This is the British pound. You can see we also had a recent record for pound shorts. Now this is the SSI. The SSI, I plot this on with a 10-day average because I like to have the meat, of the move and filter out the signals that are back and forth, the short-term gyrations. But you can see here, this is the retail trading crowd, and they go short and stay short as price rallies, okay? And then they flip and start going long as the downtrend begins, and they stay there, and then they go short at the bottom. So this is what you want to go opposite to. See, they're trading like hedgers. In fact, you can see the blue line is, this is on a weekly basis now, the blue line is COT, commercial positioning, and the black line is the SSI, FXCM SSI. It is the exact same, right? They're trading like hedgers, but you have to have very deep pockets in order to withstand something that goes against you the entire time and then turns around. It's like a martingale strategy. So bottom line is you want to trade. The money is made in the trends. That's where that's where you can make big money and lose big money if you're on the wrong side of it. But the professionals, by the speculators that are quantified their COT, they increase their holdings when price is going their way. They're correct for most of the time. They're wrong at the turn, right? But once the turn occurs, they quickly change to the other side, and then the whole process repeats itself. Retail trades like commercials, right? They're wrong most of the time. They're correct at the turn, but then they get out of the winning trade and start doing the other thing again, going the other way. So just to review, right? Market turns occur at extremes, but then how do you define those extremes? Well, you can use the percentile method that I did with the COT by defining when, on a 13-week basis, speculators are the longest they've been or the shortest they've been, and look at it in the context of recent price history to find out if it could be a turn from a sentiment extreme or if price is recently reversed and a new trend's begun. Right? And again, retail money fades the trend until they are correct, but then abandons their correct trade only to repeat their mistake all over again. And all this information, this is all in my book, the COT stuff, in depth. That's a lot of it is in there, along with some other sentiment ideas and a lot of the stuff about the going contrary to magazines and whatnot. So that's all the information that we've got from here. And if there are questions or need clarifications or anything, then I'd be happy to do that now. So yeah, I'll start here, work my way back, and kind of go like up and down. So. Do you have an example of the COT report? Yeah, sure. The question is, do I have an example of the COT report? Here's how you can get this data yourself. And it's completely free, too. There's no internet here. It's the one thing I asked for was internet. I don't know. But okay, if you want to get the COT data, you go to cftc.gov, and then you'll find there'll be a tab on the right. It'll say Historical Commitments of Traders. And you click on that, and then you can download the data into Excel. And there's only 4 columns that you need, and that is speculative longs. Well, it'll say, I won't say speculative, it'll say commercial longs, commercial shorts, non-commercial longs, and non-commercial shorts. There's a ton of information in there, other stuff, and like open interest and whatnot, but to me, those 4 tell everything I need to know. No, COT data is only once a week, and it's with a lag, so it's big picture stuff. So it's reported, it's released every Friday at 3:30, It's usually, yeah, it'll be on their website at 3:30, the CFTC website, and it's reported as of Tuesday's data. So the data that came out on Friday was as of Tuesday. Why the futures exchanges are not up to date, I'm not sure, but that's just the way it is. Yes, sorry, that is Eastern time. It's 3:30 Eastern time. So if you're on the West Coast, it'd be 12:30 when that data comes out. It's a good thing to look at as the week ends, because then you can gauge how much positioning has changed in the most recent history. Has there been a lot of speculators added to the position, or they reversed their position and whatnot? Yeah, another one right here.
Do you have an example of your spreadsheet from Excel?
I don't have anything on here from Excel. I keep everything in TradeStation now too. But how to make a spreadsheet? If I can. Well, after you download the data, you have it already in spreadsheet form, and then you use a percent. It's called a percentile function or a percent rank function. Those are the function in Excel: percentile or percent rank, and that's what you can use to do it. It's pretty simple. If you can go just click on in Excel and read about the function. Mm-hmm. No, you can't. I mean, I work at FXCM, so that's why I have it. It is, but if you have an FXCM account, though, it's updated twice a day, so you can look at it twice a day. I only look at it at the end of the day anyway. To be honest, I don't know. You'd have to ask the guys in the Daily FX Plus booth. I don't know. I'm not sure. Oh, well, I was just explaining, when you're looking at the COT chart, it'll be, if you're looking at longs, okay, like for speculative longs, that'll occur, peaks in that will occur, say, when the dollar yen or dollar CAD is at a bottom, because that you're looking at the peak in CAD positioning or yen positioning, not. Mm-hmm. When commercial traders are very long, price will be at a bottom. When commercial traders are at 100, you have a bottom in the underlying price. Commercials are longest at the bottom and shortest at the top. And the direct opposite for non-commercial traders or speculative traders. Anything else over here? So, right here. Yeah, well, speculators, the ones in COT are the ones that are large enough they have to report their positions. So they're going to be hedge funds or very big trading individuals. So they'll tend to be sophisticated trend followers. It's big money, Anyone else? Oh, yeah. I don't put that in there. One thing to look, because I don't put it in there, David Rodriguez does include put call information, options in his options report, sentiment report every Thursday. So he includes that in there. Looks at the volume of puts against the volume of calls. He includes that. It's, I'm not sure. I think you can find actually that stuff for free too on the CBOE website, Chicago Board Options Exchange. So check out cboe.com. I think you can get that on there. But all these things show the same thing. They'll move the same direction, and so will rate of change indicators. As price goes up, certain traders go long, speculators, and hedgers go short. As I showed you, the SSI moves the exact same as COT. Right? Rate of change also goes up. RSI goes up. So all these, everything's going to move together. Looking at all these indicators might do more harm than good sometimes because they all show the same thing. Yeah. No, there is hope. Just don't do it. That's why I showed you that. For example, That's why I showed you what retail traders do, so that you know not to do it. When you have the SSI, which is coming, here it is. Okay, and this you can get this on, if you have an FXCM account, you get this twice a day. This is only once a day, so you have this information. All right, you know where the SSI is. You know if it's positive or negative. Okay, you know where it's been because they show you a chart of that on Daily FX Plus. So if SSI is negative and has been decreasing, that means price has been going up, then you should probably look for buy points. But most people won't. Most people will look for short to go short because they're trying to find the top every single day, right? Or the opposite. Even to point where I'll get emails all the time about the euro's falling, and someone will send me an email. Well, I think the euro is going to go to 133.50 before it goes down to 120, and the euro will be at like 133.10. I'm like, well, why would you risk going long for 40 pips when you think eventually it's going to go down 1,500 pips? But people think like that. That's how they want to catch the exact top. You can't be perfect in this stuff. Find the trend and go with it, but have a point at which you know you're wrong. And it might be when it might be indicator based when the SSI turns the other way, or it might be just a hard stop level, or whatever. Yeah, right here. Everyone, I don't know. It's humans are irrational. That's what I come away with it. I know. You shouldn't be. It's about you just shouldn't be excited about it. Most people are just because that's the mentality. People want excitement. It's an emotional impulse of excitement. A lot of people will trade for the wrong reason. They don't trade because they love it. They trade because they love the excitement of it, not figuring out the game, the real game, the psychology behind it, right? Well, this stuff is like this bigger picture thing I'm looking at, once a week. SSA, I might look at it every day, because you look at the end of the day. But, COT comes out once a week. So I just want to know bigger picture landscape where, where that quantification is, is this percentile index at 0 or 100, So that's not necessarily a trading signal itself. It's more like a warning signal. The trading stuff, I do a lot of things on seasonality, intraday seasonality, times, best times to go long and short based on the history of highs and lows, whatnot. I did that this morning. But as far as oscillators, I don't use a whole lot of oscillators. I'll look at RSI rarely, but other than that, I like to look at extremes and rate of change. For example, I'll tell you right now, like the Dow, this is tomorrow. I'll talk about this tomorrow, but the Dow just had its largest 52-week rate of change. It's only happened 3 times in the history of the Dow, and one was 1929, and the other one was 1933, and we just had that a couple months ago. So these are things, yeah, this could be pretty scary, actually. So it's things to keep in mind. Over here, anybody else? I like that tune. And we can Let me write this down, just in case you guys didn't get it this morning. I'm going to write down my email address, because I forgot my business cards. But we have here my email. If you want to send me an email asking, what I'll do too is I'll put together a spreadsheet that you can look at and make this, so you have the numbers, you can do it yourself, get a better understanding of it. So I'll put together a sample spreadsheet and you can send me a request and I'll send you that stuff too. Yeah, the PowerPoints are all going to be up. I don't know the website yet, but obviously if you're here, you've registered, they have an email address, you'll get an email saying where it is. My guess is it'll probably be on maybe the expo site itself, fxcmexpo.com, but I don't know. But it'll all be up. All the stuff will be up.
What was the big rate of change in the Dow that just occurred?
52-week rate of change. And I believe it was like 59%, something of that nature. I'm going to show it tomorrow. I've got charts tomorrow. It's going to be the presentation I do with John Kicklighter. And that's, where's that? Trading Opportunities and Forecasts in 2010. Yeah. It's at 1:30. That's 1:30 to 2:30. So that'll be very interesting. There's a lot of very extreme rate of changes on 12-month basis in the Australian dollar, dollar CAD, New Zealand dollar that have happened over the last several years. And the implications going forward is what I'm going to explain tomorrow. Yeah. Anybody else? Anything? Anything related to currency trading, that is. Oh, well, yeah, it's on, the best way to do it is just on Amazon.com. I always say buying online is always the cheapest, It's like you can get literally half the price if you buy it in a store or something. But yeah, it's just Sentiment in the Forex Market is the book, and it's, Amazon is always the cheapest way to go, I think. It's always what I found. What's that? Oh no, I don't own any stock right now. I own puts, but I own puts on the Nasdaq and the Dow, the diamonds and the QQQQs. Anybody else? If not, then we're gonna, I guess, head out and you're free to go and do whatever. Thank you very much.